Are you wondering how your credit impacts your mortgage loan? Well, did you know there's actually 5 factors that determine your credit score? Hello, I'm John Thomas with Primary Residential Mortgage, and I'm here today to discuss the 5 factors that affect your credit score so you can better manage your credit during the home loan process. So the biggest factor, the first factor, is payment history. Now, all 5 are not treated equally. Your payment history is 35% of your credit score. So what is payment history? Great question. Your payment history measures how well you pay back the debts that you incurred or you borrowed. So if you're paying whatever loans or credit cards you have on time every single month, that's going to have a positive impact on your credit score. Now, if you're paying late or you actually get collections or charge-offs or judgments, that's going to have a negative impact on your credit score and it's going to make it go lower. So what you want to make sure you're doing is you want to make sure that you're paying your credit cards, your car loans, your student loans, any loans or debts that you have. You want to make sure that you're paying them on time so that has a positive impact on your credit score while you're going through the loan process. The second factor is outstanding balances that you're carrying on your credit lines. So that is going to be 30% of your credit score. So the first 2 categories account for 65% of your credit score. So outstanding balances is where they're going to look at what your available credit limit is compared to how much you owe. So if you have a credit card with a $1,000 limit and you charge up $300, you're using 30% of your credit limit. So what I want you to understand is there's different measures that affect your score so you can manage we call it your revolving debt. So a revolving debt means you can charge it up, pay it back down. So if you have a credit card with a $1,000 limit, if you want to get the most points for that trade line, you want to keep your outstanding balance when it reports below 30%. So on a $1,000 credit card, keep it below $300. And then make sure you pay the bill on time when it comes. If you can pay it off in full, that's even better because then you pay no interest. Now, if you happen to charge it up to 50%, which is $500 on a $1,000 credit limit, you're going to start losing points because they're saying you're using too much of your available limit. So when you hit that $500, they're going to take points off. Now, if you charge it up to 80%, you're going to lose even more points. So $800 on a $1,000 card, when you hit that $800 mark, they're going to take points off. Now, if you max it out, $1,000 on a $1,000 limit, they're going to take even more points off. Now, if you go over the limit, which they'll let you do, they're going to charge you not only an over the limit fee, but they're also going to ding you again to your credit score. So if we're trying to keep our score as high as possible, we want to keep the balances on a revolving charge lines like credit cards, home equity lines of credit, personal lines of credit. We want to keep those below 30% if all possible. If your score is lower and you're trying to get it up, then you want to look at paying down those trade lines. Get them below 80 is good, below 50 is even better, below 30 is going to get you the most points for those trade lines. So that's the second big factor that's going to impact your credit score. Now let's go ahead and look at factor number 3. Factor number 3 is length of credit history. So we're looking at how long have you actually had credit. The longer you've had credit, the stronger you are as a borrower if it's good credit. So that's going to be a 15% impact on your credit score. So the longer, the bigger the credit file, the better it is for your credit score. Now, if you have no credit score at all, the current scoring model says you got to have something that reports for at least 6 months, then it will generate a score for you. So if you've got a credit card you've had for 5 years, that's a 5-year credit history length. That's very good. Now, if you were to close that card and open a new card, that would be very bad because when you close that card, you lose that 5-year credit history, and the new card you open now has no credit history. So be mindful of your credit history. Keeping stuff the longer you can, the better it is for you. So that was your third factor. Now, if we look at the fourth factor affecting your credit score, the fourth factor affecting your credit score is your type of credits or your mix of credit. It accounts for 10% of your credit score. Not a big deal, but you can be mindful. It might give you a couple extra points. So the credit bureaus are going to give you some points for having a good mix of credit, like 3 credit cards, a car loan, and a mortgage, maybe a student loan. The more you have, the better mix or different types of credit. And if you're paying all those different types of credit on time, it's going to make you a better credit risk. Now, if all you have is one credit card you've had open for 1 year, then you're not going to have a great mix of credit because you only have one card and it's not seasoned very long. But again, it's only 10% of your credit score, so not a huge deal. The fifth factor affecting your credit score is new credit, or sometimes called inquiries. Again, it's only 10% of your credit score, but if you open new credit or get inquiries, it can have a negative impact on your credit score. One inquiry, maybe 1 to 3 points you would lose based on that inquiry. But if you are shopping for, say, a mortgage, and you have 5 people check it, that's not 5 different inquiries for the scoring purpose. That's only 1 inquiry, and it doesn't affect your score for 45 days from the first inquiry for a mortgage. Now, if you get a car dealer checking it after the mortgage, well, that's a different type of credit, so that would be considered a second inquiry. But the inquiries don't typically take away your score until 45 days after they're checked. So it is a part of the scoring model when you do open or get new credit, but it's only 10% of the credit score, so it's not something to worry about. And if you get your own credit score, that's called a soft inquiry. A soft inquiry does not affect your credit score at all. It's the hard inquiry where you're actually getting an inquiry applying for a loan. But if you want to get pre-approved for a mortgage, you have to get a hard inquiry, because a lender cannot pre-approve you without a hard inquiry, because they actually have to get an official copy of your credit report that they import into their automated underwriting system, and it reads that credit report to base part of its analysis on whether you can actually qualify for the loan or not. So if you don't let the lender pull your credit, you can't get really pre-approved for the loan. So make sure you get a good credit pull, and they do a solid pre-approval. And then the other question is, how long is that good for? Well, the credit report is good for 120 days before the lender would have to pull a new one. So if you have a credit report pulled and you're pre-approved, you have to close within 120 days, or the lender will have to pull another credit report. When it does that, you get another 120 days. So that's the 5 factors that impact your credit score. Hope this helps you manage your credit during the home loan process. If you have any questions, or if you want to get pre-approved for a mortgage, you can give us a call in the office at 302-703-0727, or you can go online to prmiloanapplication.com and start the process right there. Hope you guys have a great day.